Hello, I'm instructor Chris Culver, and I wanted to give you a very brief overview of debits and credits. I think debits and credits are really a difficult thing for a beginning accounting student to understand, and so I'm going to try to simplify it as much as possible. That means we're going to leave a few things out for the time being and pick them up in a subsequent lecture. So we're going to focus on just the very basics of the debits and credits. So the first thing you have to do is make sure that you've memorized the accounting formula, and most of you probably already have. The assets equals liabilities plus owner's equity. And I usually always encourage people to begin writing it in this format because it's going to be a clue that helps us understand how debits and credits work. And of course, assets are the things in a business that have future economic benefit. And so there are things like inventory and accounts receivable, machinery and equipment, land, cash, of course. For us as individual, assets might be things like the balance in our checking account, the car that we own, the home that we own, money in our retirement savings account. So assets, things that have future economic benefits. And liabilities are things that require us to make future economic sacrifices in a business that's often accounts payable, notes payable, bonds payable, unearned revenue. For us as individuals, liabilities might be things like our Visa card balance, our car loan balance, our home loan balance, any debts that we may owe. And then owner's equity is the difference between the two. And this formula is supposed to show us what resources a business has, which would be its assets, and then who provided those resources, whether they be creditors, which would be liabilities, or whether they be owners, which would be in the form of some kind of an equity position. Now, equity is kind of, we have a couple of different terms that we use when we get into the equity section. So for a partnership and a sole proprietorship, you would normally hear people discuss something called capital. And for a corporation, we would talk about common stock and retained earnings. And so depending upon the type of entity that you might be dealing with, you might find different terms within the owner's equity section. But for now, it's just good enough to know what assets are, what liabilities are, and then what equity is, and have this formula sort of memorized and put yourself in a position where you can write it down in this particular manner. Now, on this particular slide, I've just given you some additional, examples of what the assets are and what the liabilities are and what the owner's equities accounts would be. For any problem that you might do or any company that you might encounter, one of the first things that you would like to do is to have a look at the chart of accounts or maybe a trial balance, both of which would show you a list of all of the accounts and break them into these particular categories so that you would know what the assets are, what the liabilities are, and the equity section. And if you're new to accounting and you're not familiar with many of these accounts, I would point out that in our learning management system, Moodle, there is a Excel spreadsheet that lists all of the accounts, what type of accounts they are, whether they're assets, liabilities, equities, or some other account types that we'll talk about in the future, and then where they sit in the various financial statements. And that Excel spreadsheet is a really good overview of the accounts and how they, some of the basics of the accounts. So this is the key formula or the key way to begin to think about debits and credits. So you can see here we have assets equals liabilities plus owner's equity, which is the same formula that I encouraged you to memorize a couple of slides ago. And if you can write that formula down in this particular way, then I'll give you just a very easy way to think about the debits and the credits, and that is the accounts on the left, or the things on the left, in this case the assets, go up on the left, and the things on the right go up on the right. So the liabilities and the equities, since they're on the right side of the equation, they increase on the right side of the accounts. And the assets, which are on the left side of the equation, increase on the left side of the accounts. Now, debits and credits are abbreviations of Latin terms that literally mean left and right. I don't know. I think like any discipline, we like to think that we have a long and rich history that goes all the way back to Latin, which is sort of the dawn of the intellectual age. And so if we don't use Latin, we feel like we're being, left out or something. But you literally could do a whole term of accounting. You could do your entire career of accounting simply with lefts and rights if you wanted to. But, you got to be cool, so you got to use debits and credits. So assets increase with a debit and they decrease with a credit because they're on the left side of the equation. And then the right side of the equations, the liabilities and the equities, they increase with a credit and they decrease with debits. And this allows our equation to always stay in balance. Now, for any given transaction, the debits for that transaction must equal the credits for the transaction. And so if we can solve one half of the transaction, we can kind of by default solve the second half of the transaction. But the key to this is to know the formula, assets equals liabilities plus owner's equity, and then remember the phrase that things on the left go up on the left, things on the right go up on the right. And from that, everything else can sort of be solved. I'm not a big fan of memorizing things, so I think, kind of keeping it simple is the way to go. So when you're trying to do these transactions, trying to come up with the debits and credits for a transaction, I like to go through this 4-step process, particularly when you're new. Later, after you've done 100 transactions, you'll be able to jump to the answers. But in the beginning, you have to sort of look at a transaction and say, okay, what are the accounts that are impacted? Was it cash? Was it accounts receivable? Was it the capital account? Was it the accounts payable account? You have to first look and say, okay, what are the accounts that this transaction involves? And then you have to decide, where do those accounts sit in the equation? Are they an asset? Are they a liability? Are they equity? So you identify the accounts, you identify where they sit in the equation, and then you have to look at the transaction to decide whether or not, which particular accounts are increasing or decreasing. And then from that, you can solve the debits and the credits. So let me take you through a couple of simple examples. So an owner invests $10,000 into the business. So the first part, what are the accounts? So cash and then some equity account, which would be common stock or capital. And then where do the accounts sit in the accounting equation? Well, we know cash is an asset and the capital account is an owner's equity account. So now we've kind of got them set into the equation so we know where they're at. And then are the accounts increasing or decreasing? So the cash in the business is going up because there's been this contribution of cash. And then in exchange for that cash, common stock or capital is also increasing. So cash is on the left, that is, it's an asset, so it increases on the left with a debit. And the capital account is on the right, and so it increases with a credit. And so you can see here the appropriate response for this transaction would be to debit cash $10,000 and then to credit common stock $10,000. But if you follow that process of, what are the accounts? Where do the accounts sit in the equation? Are they going up or down? And then work into the debits and credits from the answers to those 3 preliminary questions, you'll be able to work into solving most debit and credit accounting problems. So here's a second example. So a business purchases $2,000 of inventory on account. So the first part, what are the accounts? So inventory and accounts payable are the 2 accounts that are being impacted by this. Where do those accounts sit in the accounting equation? Well, inventory is an asset. It's something we're going to sell in the future. It has economic benefit to us. And then accounts payable is a liability that we're going to have to pay at some point in the future. So we have an asset and a liability that are involved. And are the accounts increasing or decreasing? Well, the inventory is increasing because it's coming into the business. And we have this new debt that's increasing. This accounts payable is increasing also. So inventory is an asset. It's on the left, so it goes up on the left. So we're going to debit inventory. And then accounts payable is on the right, and it's increasing, so it's going to increase with a credit. So we're going to credit accounts payable. And so again, it's that same process sort of working itself out. And if you go to your text, you'll find, many examples within the various chapters. And I would encourage you to sort of deploy this assets equals liabilities plus owner's equity. Things on the left go up on the left, things on the right go up on the right. And this process of sort of analyzing the transactions to work through some of the examples that they provided you with solutions to kind of begin to get the hang of it. Now, in some sense, I've oversimplified, but I don't want you to really take it any further than what I've just done right here for the moment. Now, the exceptions are revenues and expenses, which are a tiny bit harder to understand, and then things like contra accounts, which would be things like draws and dividends and accumulated depreciation. And so in a second slideshow, I will take you through those exceptions, but for now, focus on the assets equals liabilities plus owner's equity. Become clear that things on the left go up on the left and things on the right go up on the right. Get a sense of the accounts and where they sit in the equation, and then follow that 4-step process for analyzing transactions so that you can begin to come up with the debits and the credits. And then once you kind of get a little bit of a grasp of that, we'll go on to these exceptions. Now, I'll add one more caveat and then we'll wrap things up here. One of the things that's difficult for students is they come sort of pre-programmed sometimes with ideas about debits and credits, because we've all had things like in-store credits, or you've had a credit balance, or maybe you have a credit card, or also you have a debit card. And so we have perceptions about what debits and credits mean because we've interacted with those two terms in these other ways, in these other circumstances. And it's best just to forget all of those things. Debits and credits are not good or bad. They're not anything in particular. They're literally left and right. And so if you sort of clear any misconceptions that you might be bringing into the course about debit cards and credit cards and various things, and you just sort of let that go and you just think left and right, debit and credit, the lefts have to equal the rights or the debits have to equal the credits in a transaction, and work through this simplified process, you'll begin to get the hang of it. And then, like I said, in the next slideshow, we'll take on these exceptions. And if you've got the foundations down, then these exceptions or these slightly more difficult things really can build off the foundation, and they're not exceedingly difficult. Well, thank you for joining us and tuning in here, and hopefully you can join the next presentation as well. And take care.